say is this is going to be a highly interactive training webinar, and I want everyone to participate as much as possible. I'm going to be asking some questions. We're going to be filling out some forms. We're going to be going over numbers. The best way to learn is to actually get your hands dirty and deep dive into numbers for me personally. And I'll talk about my background and why I'm so passionate about numbers. So with that, what I want everyone to do right now is to go ahead and download a workbook, because I want you to focus on having the notes in front of you so you don't have to write everything. A lot of it is in there. So go ahead to this website and download the workbook and an Excel spreadsheet so you have it. So go ahead and do that right now. I'm going to give you a minute. And the website is www.finance. Finance is spelled in a weird way. FYNANC. There's no E in the end. .com/quest. Okay, and you'll find there two links. One is for the PDF for all the notes, but also we're going to be filling in some blanks and some stuff. And there's going to be an exercise as well. I'm going to have you do the exercise together, so this way you learn how to structure deals, within this 1 hour. So go ahead and download that, and let me know if you have any problems or questions doing that. Let's see if perfect. So you'll see the link on the chat. Again, just click on the link in the chat window. To get to the chat window, I believe it's in the bottom part of your screen. So so go ahead and do that right now, your workbook and the spreadsheet, but more importantly, the workbook. And go ahead and open it, open the PDF on the side, because we're literally going to be doing this. And if you can start printing, and that would be even better. So with that, let's dive into the training here. Let's talk about why is this training first important, okay? This is a huge thing here that I've seen happen to over 95% of investors out there. So here's the story. So the story starts with 4 investors. They're all friends, and they all decide to invest together. Okay, and we're going to call them investor A, B, C, and D. And they buy identical rental properties right next to each other. So they all collect $1,000 in rent. So all these properties are rented, and the rent is exactly $1,000 from each one. Investor A will lose the property to foreclosure in 2 years. The same identical properties, same tenants, same rent, okay? They'll lose it to foreclosure in 2 years. The next one, investor B, will give up too soon and say, you know what, real estate investing doesn't work. Investor C is moving backwards financially, even though he's making money. This is going to sound weird. Listen, folks, to this. Even though he's making money, but he's actually moving backwards financially. And unfortunately, he won't find out until he retires, okay? And that's when it's too late, because he never knew there was a problem until it was too late. And that is the worst type, because they're not going to be able to fix it until it's too late. And investor D is the only investor moving forward out of the 4 friends. Question is, what is the difference? It's the same property, same rent, same tenants. And I will tell you this, that most investors have no idea what the difference is, and that's what we're going to cover today. So that's why this is so important. So make sure you really go through this whole training with me and fill in the blanks, do all that stuff, because you will totally understand why investor D is doing the right thing here. So with that, let's talk about the reality for most investors. Most investors out there are walking around saying, I'm an investor with nothing to show for it. Okay, I've seen it happen over and over again. I have seen people that have raised money from friends and family and lost all the money and the properties. Okay, in fact, one gentleman in Florida raised $1 million from friends and family, bought properties, and within a few years had lost all the properties and all the $1 million. And think about that. And all that's missing is what we're going to be talking about here today, which is what's called the capital structures. That's why this is so critical that you get this training. And unfortunately, many people don't realize that decisions they're making today will impact where they are 5 years from now. And these are simple decisions that we're going to be covering today. And you'll realize just from the things we do that most investors have no clue where they're going to end up 5 years from now simply with not knowing this information. So with that, let's talk about a little bit my background and who am I and why should you listen to me. So I started with in technology. My background used to be as a software developer for a few companies, including Intuit. I worked on a software called Quicken and some of Intuit's other products. I also worked at a number of other software companies, including Microsoft and some other ones. I also, in 2001, I left that world and I got into real estate, and I started buying apartment buildings, rental properties, ran several private lending funds, and I became, quite experienced with a lot of different investments within real estate, commercial and otherwise. I've also raised tens of millions of dollars for everything from real estate to business ventures to infomercials, you name it, I've raised money for it. And I'm considered a thought leader in the investing and finance space. So the question is, why should you listen to me? I could tell you I'm the author of 3 best-selling books, but you know what? Honestly, who cares? I could tell you I've been the radio host on the Wall Street Radio Network. Again, who really cares about that? I could tell you I founded the world's largest network of private money lenders, but you know what? Who really cares? I could tell you I'm the founder of Finance Academy, home of the finance hackers, but again, who really cares? Here's why you should care, okay? Because this information can be the difference between success and failure in your investing. Now, if you didn't get it, my background has a lot to do with numbers. And that's what I'm going to be talking about. My nature is I'm very skeptical, so everything I look at is numbers, and we're going to be deep diving into numbers and understanding that. So with that, let's get into the agenda for this training. And this is the agenda we have. And what we're going to do is we're going to look at, we're going to start with what we call the deal. So we're going to do a deal together. And again, I want you to download the workbook, because in the workbook on page 3, there's an exercise, and I'm going to ask you to fill out the deal here in a minute. So make sure you download the PDF, and I'm going to ask you to look at an exercise here very soon. And that's the best way to learn, folks. So again, make sure you you follow with me here. Pay attention as much as possible. Ask questions, because I'm big about asking questions. I'm going to be going at a good pace, but I'm here for you to answer any questions you might have. So with that, let's do an exercise together. And this is again on page 3. Let me, this thing decides to remind me right now that oops, how do you do this? Okay, my computer decides to freeze now. Okay, there we go. Are you there still, Nate? Perfect. Okay, you can hear me, right? Okay, perfect. So let's go ahead and do the exercise. So that's on page 3 again. And what I want you to do is open to page 3, and I'm going to walk you through this exercise and ask you questions. Again, the whole idea is to learn from actual data, actual numbers here. So before we start with the exercise, let me just say this. What we're going to learn here is how to structure deals for passive income from any income-producing asset. I'm going to say that again. From any income-producing asset, not just real estate. It could be private lending, it could be notes, it could be anything that generates income-producing asset. However, what I'm going to do in my examples, I'm going to use real estate because most of you are investors and can relate to seeing a property. But this works for any asset. So here's the deal. Again, we're going to use real estate as an example. You're looking for a 10-year buy and hold for income. This is the asset. Okay. You find a great income producing asset, you're going to hold it for 10 years, and it's worth $100,000. What you want to do is you want to structure the safest deal possible for passive income. This is so critical. Listen to the words carefully. You want to structure the safest deal possible for passive income. So for the 100,000, you find you need an 80% loan. You call your broker, your mortgage broker, and they give you 5 options. Again, these are examples here. And the question is, which of those 5, again, this is on page 3, which of those 5 will you pick for your 80% loan? Now, keep in mind, the objective here is to make this as low risk as possible. So what I want you to do is take a minute. And again, there's nothing wrong for getting this wrong or right. It's best to learn from your mistakes. So go ahead and make sure you're participating in this because, like I said, this is the best way to learn. So go ahead and pick loan option A, B, C, D, or E. And when you're done, go ahead and I'm going to be asking you a question here. Take a minute and pick what you think is the right loan. Okay, so I see a lot of people are typing different things. So what I'm going to do, because I see a lot of people typing stuff, I'm going to ask whoever thinks it's loan option A, go ahead and say something, say A or whatever. Just type A. If you think it's A, go ahead and type it. Okay, I see a lot of people typing A. If you think it's B, go ahead and type B. Okay, I see B. Okay, C. If you think it's C, go ahead and type C. Okay, I see D as well. So a lot of people typed D before. So if you think it's E, go ahead and type E. Okay, E. So we know so far we've picked A, B, C, D. If you think it's E, go ahead and type E. Okay, so everyone typed A, B, C, or D, but no one is typing E. That's fine. Okay, if you think it's E, I'm going to give you last chance here. Okay, so let's go ahead and move on to the next question. So far we've gotten A, B, C, D. No one typed E. So with that, let's go into the next piece here. So now we covered the 80% loan. Now we're trying to pick the down payment. So you have 6 options for the down payment. You have option 1, option 2, option 3, 4, 5, and 6. So go ahead and take a minute and tell me which do you think is the best down payment option for the down payment, 1 to 6. So take a minute, and then I'm going to ask you to tell me what you think here. But go ahead, just circle it in your workbook. Okay, so I see people going 1, 3, 5. So let's go through this. So I see a whole bunch of people type number 1. If you think it's number 2, go ahead and type number 2. Okay, so far we have almost, okay, we have 2, we have 3, and I see people typing 4. I think I saw 4, yeah, 4, 5, and did anyone type 6? Yeah, we saw 6. Okay, so now we have every number here. Now, here's what's interesting, folks, and I want you to really listen to this part. So we had 5 options for the loans and 6 options for the down payment. That gives us 30 different possibilities. And what you guys selected are 4 out of the 5 here and 6 out of the 6. So that gives you 6 times 4 is 24. So you selected 24 different options out of 30 different options. And guess what? There's only one right answer. Now, what does that tell you, folks? Okay, what does that tell you? So go ahead and type what you think this means to you. There's one possible out of 30, and you guys gave me 24 out of the 30. So obviously that means you're not sure what the answer is, and there's a lot of guessing going on. And guess what? That guessing, thank you, Marianne. Marianne said, we obviously don't know what the hell we're talking about. Okay, perfect. Here's the thing, guys. That guessing is where people lose their shirts. You are an investor, and people are investing their hard-earned money with you. There are people out there that are working for years and years and years, and they're putting their hard-earned savings with you to invest, and yet you don't know the answer to that. That's why this is so important, because we all have an obligation as investors to make sure we know how to structure the deal so it's low risk for our money partners, it's low risk for everyone, but also it has maximum return over time. And that's why this training is so critical. And what we're going to do now is we're going to actually continue with the training, and you are going to figure out the right answer as we go through the training. So at different points, I'm going to stop. I'm going to ask you to revisit your answer. And by the end of this training, you will all have the exact correct answer. Okay, so that's the deal. Again, let's talk about the problem really quick. So now you experience what I mean when I say people are losing their shirts because of incorrectly structured deals. And I just demonstrated that. There are people losing literally 7 figures from money raised. And that's, again, the problem. So with that, let's talk about the foundation of this blueprint and how do you go about structuring a deal so that it's low risk. And again, we're going to make sure that we're going to come back to this exercise and we're going to come up with the right answer. So with that, let's talk about the foundation here. So whenever you're structuring deals, there are really 3 aspects and 3 skills that you really have to focus on for every single deal you do. There is the raising the money on the left here. That's the money you need to invest in the right assets. And you want to structure the deal correctly. So you cannot skip any of those things. In other words, if you are good with 2 and you're weak in 1, you can lose your shirt. So let's pick any 2 here and see what happens. If you're really good in, let's just say, raising capital and in structuring the deals, but you invest in the wrong assets, what would happen? You would lose your shirt. If you're really good in, say, raising capital and investing in the right assets, but you can't structure the deals like we just demonstrated, you're going to lose your shirt. What if you're really good in investing in the right assets and structuring the deals, but you can't raise a penny? Obviously, you're not going anywhere. So really, you have to master all 3 sides of this triangle, okay? And that's what we call a top-tier investor. So this is on page 7 of your workbook. Again, a lot of this is just, I gave you the notes ahead of time, so you don't have to write too many things. In fact, I gave you checklists and all kinds of stuff. Make sure you download the workbook. It's all in there. So this is the same triangle, but we summarized the names here to capital, asset, and capital structure. Again, this is the capital you need to buy the asset, and the capital structure is what we're going to talk about. So let's talk about some terms that you've heard before that are associated with the capital side. Okay, so someone is asking where to get the workbook. So it's in the chat. Just go up to the very top and you'll see the link, okay? So let's continue here. What are some terms associated with the capital side? So you've heard training out there on how to raise money. You've heard of mortgages. Obviously, we all need a mortgage. Seller financing is on the capital side. Creative finance, you've probably heard that. That's on the capital side. Syndication is another term. That's on the capital side. On the asset side, you have things like rental properties, buying notes, mobile homes, apartment buildings, trusted investing or private lending. These are all on the asset side. Tax liens, these are all on the asset side. What we're going to cover today is the capital structure. Now, you'll find out that there's a lot of training out there, excellent training on either the asset side or the capital side, but very few people are talking about capital structures, and yet capital structures is where people lose their shirts. So that's why this is really important that you understand capital structures. So what I'm going to do now is on page 5 of your workbook, I have a fill in the blanks so that as we go through this, you're going to be filling in the blanks, and we're going to start doing that right now. So on the very top, you'll see on page 5 says the 3 aspects of every deal is capital, asset, and capital structure. Fill that in. So what is a capital structure? A capital structure is simply how an asset is financed. In simple terms, this includes how much capital is debt and how much is equity. So you want to fill those in, debt and equity, which we're going to talk about here in a minute. Now, let me just tell you this. I have students doing deals from $50,000 all the way to $50 million. And without knowing this information, you can lose your shirt. This applies to every deal you can think of. And specifically, we're talking about here income producing assets, not just real estate. I want to stress that out because a lot of people always come back and say, well, I'm doing this kind of investing. You still need to know how to structure the capital. So that's the definition of a capital structure. It's nothing more than how much debt and how much equity. And it might sound simple, and it is simple, but that is where people go wrong with having too much of one or the other. So again, that's on page 5. Fill that out. So there are 2 types of capital. Whenever you're talking about capital structures, you have to understand there's 2 types. And those 2 types, the balance of them is so critical. So it's debt and equity. Again, fill that out on page 5, fill in the blanks. And we're going to learn how to structure that based on the asset. So what I'm going to talk about now is the difference between debt and equity financing in simple terms. So debt financing is when you lend or when you borrow money and you have to pay back with interest. So when you borrow money from a bank and you have to pay them with interest, or you borrow money from an individual and you have to pay them with interest, that's debt. They don't get a piece of the property, they simply get, you simply pay them with interest. Equity financing is the other way around. It's when you raise money, let's just say from a partner, where you're giving them a percentage of the profits. So if there's no profits, you're not obligated to pay any profits, obviously, because there's no profits. There is no interest with that. So equity is where you're sharing in the upside. So I raise 50,000 and we go, let's just say 50-50 in this example. And so equity financing is almost like a partner, okay? So these are the 2 core types when you're putting a deal together. And here's how this looks like. Debt is debt financing. This is typically a mortgage or a loan. And equity financing is simply when you raise capital from an individual and you give them a percentage of the deal. But your capital, if you put up your own money in the deal, that's considered equity as well, equity financing. Okay, so go ahead and fill this out on page 5. So we're starting with the really basic pieces here, and we're going to start adding to that because it gets really interesting from here. So as you can see on the screen, this is a skeleton, and the skeleton, as we all know, is the body part that forms the supporting structure of an organism. Same exact thing with a deal. A deal has a skeleton, and the more you understand how the skeleton works and the pieces, the more you can control the deal. And so a skeleton looks like this for every single deal, for passive income deals. And we're going to be deep diving into how we control these pieces of the skeleton. Again, this could be a $50,000 deal. It could be a $50 million deal. I have students from all walks of life doing small deals and large deals, okay? And this is what it boils down. So similarly, passive income deals have a skeleton that forms the supporting structure of that deal. And the key for us as investors is we have to understand those pieces and how we control them. And that's what we're going to do in this training. So with that, let's go back to this diagram here. You'll see here, again, a lot of this stuff is in your workbook. You'll see we have something called the spread. We have leverage, and we'll talk about reserves. So what we have to do is first learn to control spread and leverage. So here's how we're going to do that. We're going to look at those as dials. So what I want you to do now is think about driving a car. When you're driving a car, you press down on the gas pedal and you look at the dashboard and you see how fast you're going, the speedometer. So same thing with deals. With deals, you're controlling the deal with the amount of leverage or percentage of leverage and spread. And as you turn these dials, what you have to realize is that your return and your risk on the dashboard change on that deal. So some people might say, let's just max out leverage because I just want to buy the property. What they just did was max out risk. And so what you have to do is you have to learn to control the deal with these 2 dials, leverage and spread. and that affects your return and risk. So let's deep dive into and understand how you control those dials, because those are so critical to the deal. So again, that's the image I want you to think about, and this is on one of the pages in your workbook. You control the leverage and the spread dial. These control the skeleton of the deal. We're going to just focus on these two right now, and then reserves a little bit later. And those impact the return and the risk on the deal. Okay, so hopefully you guys are with me so far. I know I'm covering a lot here, but this is still the foundation. Now, this diagram here is the process I have all my students use to structure a deal. And what we're focusing on is, so let's go through this really quickly. So you have 3 steps to structure a deal. You have the asset, capital structure, and the result. So what I want you to do is realize we go from A to B. And again, this is in your workbook, folks. You just follow the line. What I'm going to do here is I'm going to just focus on the asset, and I'm going to focus on the middle part here: structure debt, arrange equity, and calculate reserves. And you guys will know this by the end of this training. These 3 things here, okay, these are so critical. And that's the capital structure. So having this reference point, let's dive into, again, this is on page 11. You guys have all the notes. So with that, we just covered the foundation of the blueprint. Let's dive into the first piece, which is the spread, understanding the spread. And then we'll understand the second one, leverage, and then we'll talk about reserves. And then we'll be updating our deal and going back to the deal, and you guys will be picking the right answer. So if you guys are enjoying this, go ahead and say something in the chat. Let us know you're enjoying this. Perfect. Excellent. Thank you, Janie. Perfect. Awesome. I just don't want to go too fast. This is great. So this is awesome. Okay, so let's go ahead and talk about the spread right now. Again, as a reminder, we have these 3 dials, and we need to start understanding each one as we structure the deal. Now, you'll notice here we don't talk about real estate specifically. We just always talk about income-producing asset, because this applies to every single asset. We have students doing this on assets that fit in your filing cabinet. It doesn't have to be real estate. Again, keep that in mind. I want to just stress that, because this can be applied to so many deals. So let's start with the spread right now. Okay. So with that, we're going to take start with an example here. Let's just say that you walk into what's a store? Target. You walk into Target, and then you see this black box sitting on, a whole bunch of them sitting on a table. And these are for sale. They're $12,000 each. And you put them on your shelf at home, and they generate $100 per month in cash flow. Now, you don't have the money, but on the other side, you have your uncle that has the $12,000, and you convince your uncle to lend you the money, because it's not making him anything. And you say, Uncle, I'm going to pay you $50 per month for that $12,000. So your uncle lends you the money and takes this black box as collateral. Okay, so now your uncle's going to lend you the $12,000, and you're going to buy this black box. This black box now pays you $100. You then pay $50 to your uncle. So now you have a $50 spread in your pocket every month. Now that's your spread. Let's keep going. This is not the exact spread I'm talking about here, but this is the spread in this example. Now you have on the left side the asset, and on the right side the leverage. Let's take this one step further. Whenever you're putting deals together, you have to have on one side an income-producing asset. On the other side, you need the leverage. Okay, that's called the wealth pair. Now let's keep going here, and we're going to start understanding what to look for. On the left side, we have the asset, and we're saying in this example, it's going to pay us 10%. After expenses, it's going to pay us 10%, and we're going to turn around and we're going to pay our leverage 6%, whatever that means. Okay, so now we're creating a 4% spread. So now we're going to start taking this a step further. On the left side, this 10% is called a cap rate or capitalization rate. It's nothing more, I don't want you to complicate it, it's nothing more than a measurement. And that measurement is the net income coming from the asset. Now, by the way, all the formulas and all this stuff is in the back of your workbook, okay? So just stay with me here and just let's keep it high level for now. There's something called the cap rate that is nothing more than a measurement of the net income coming from the asset. And on the right side, there's something called the loan constant. That's a measure of how much payments are going out. Now, this is not the interest rate. This is not the interest rate. We're going to deep dive into loan constant here in a minute, but I want to just say this. When people look at interest rates for passive income, this is where they lose their shirts. So let's look at what does a loan constant actually mean. So what I'm going to do is I'm going to walk you through an example here. And I want you to really pay attention to this loan constant because it is the biggest difference for most investors. So in front of us, you'll see there are 3 lenders. And all of them are willing to lend us $100,000 at 10%. And so we have to decide which of those lenders we're going to go with. Now, everyone on the call here, we're all together and we have these 3 lenders in front of us, okay? So here's how we're going to we need to decide which lender to go with. The first lender, all 3 lenders are lending us $100,000 at 10% interest. So far, everyone is equal. The first lender says to us, pay me $10,000 per year. That's 10% of $100,000, okay? The second lender says, you know what? Pay me $24,000 a year because part of that is interest, and part of it is principal, and within 4 or 5 years, you'll be paid off, okay? So you'll owe nothing. It's an amortized loan, essentially, okay? And so his payment is $24,000 per year, not per month. And you'll be debt-free in a few years. On the right side, this lender says, just pay me $1,000 per year. And unpaid interest will get added to the loan amount. So the loan amount in the first year, you'll add $9,000 of unpaid interest. So now the loan amount is $109,000, okay? But you're paying $1,000 per year. So now the question is, which of those lenders is the best lender for us to create passive income, okay? So again, in terms of safety, the first one, the second one, or the third. Remember, they're all 10% interest rate and they're all $100,000. So what I want you to do is just tell me who you think we should go with, 1, 2, or 3. So I see people going 1, 2, 3. Okay, this is perfect. So everyone is saying 2, 3, 1, whatever. Okay, so let's dissect this for a second. So, so the person on the left says, you know what? It's $10,000 per year. Now, if we have a good year, can we pay this lender more than the $10,000 per year? The answer is obviously we can. So 10,000 is the minimum, and if we have a good year, we can always pay more. The second lender, it's $24,000 a year. So let's go back to the first lender. Can we pay $15,000 if we have a good year? The answer is yes. Can we pay $20,000 a year? Yes. Can we pay $24,000 a year? The answer is yes. We can pay anything as long as the minimum of $10,000 per year. The person in the middle, the lender in the middle, we have a very high payment of $24,000 a year. But if we have 1 or 2 bad years, do we have a choice of paying them less? The answer is no. So this here is a very high payment and we have very high obligation and we don't have a lot of flexibility. So if we don't pay $24,000 a year, we're going to lose our shirts. So let's look at number 3 here. Number 3 says, pay me $1,000 a year. So obviously $1,000 a year is an issue because the loan is going to keep growing, but can we pay $10,000 a year? The answer is yes. Can we pay $5,000 a year? The answer is yes. We have a lot of flexibility. Can we pay $24,000 a year? The answer is yes. But if we have 1 or 2 bad years, we can always go down to $1,000 and let the loan grow for a year or 2 until we get back on our feet, and then we can start paying things down again. So this has the most flexibility on the right, and the one in the middle has the least flexibility. Now, let's go back to what I just said. It's still $100,000 and it's still 10% interest in all cases. So therefore, knowing that the 1,000 is the most flexible and the 24,000 the least flexible, what metric, and listen carefully to this question, what metric is actually measuring the payment itself? Because we know they're all 10% interest. And the metric itself is actually called a loan constant. A loan constant is something that you look at above and beyond the interest rate. So how is the loan constant calculated? It's nothing more than your annual payment divided by your loan amount. So the first one is 10%, that's 10,000 divided by 100,000. The second one is 24%, 24,000 divided by 100,000. And the last one is 1%, which is 1,000 divided by 100,000. Now, why am I telling you this? When it comes to passive income, this is one of the most important metrics to look at, and yet 99% of investors have never heard of it. They look at the interest rate, and the interest rate can destroy you in many cases. So you have to look at both of them, and I'm going to share with you a few things here in a minute. But the loan constant has to be measured for every passive income deals. Now, I'm not talking about rehabbing deals here or flipping properties or none of that stuff. This doesn't apply for any of those deals. This is strictly for buy and hold long term. Okay, so let's go back to, as a reminder, it's the same identical interest rate, folks. And yet, if you picked one over the other, you could be either losing your property or not, based on the loan constant, which is no mortgage broker is ever going to give you. Now, why do you think I know so much about this? Because that's what lenders look for. See, as a lender, we look at loan constant because it's a way to shift the risk. When I'm lending money out, I know a higher loan constant. That means I'm shifting the risk to the borrower. But if I'm the borrower, I'm going to borrow with the lowest loan constant. But when I lend money out, I'm going to lend money out with the highest loan constant. You have to know this, folks. Okay? That one metric right there is what destroys most investors. So let's keep going here. So again, we want the most flexibility. It doesn't mean we're just going to pay $1,000 in this example. And by the way, a lot of people freak out about the $1,000 per year. This is just an example to make a point, okay? Which is you want to look at flexibility of the loan, which is a loan constant. And here's the other part. The loan constant is actually a measure of risk. The higher the loan constant, the higher the risk. We as borrowers, we want the lowest loan constant. If you're doing private money lending, you have to be looking at the highest loan constant, okay? So let's go back to our deal. Whenever you're looking at a deal, you're going to ask what's the cap rate from the asset, and you're going to compare that to the loan constant. You want the loan constant to be lower than the cap rate, and the wider that the difference is, the better for you. Okay, you want the widest spread possible. Again, you want the loan constant to always be lower than the cap rate, and the lower the loan constant, the more flexibility you have in your deals. And here's what's going to happen. Here's what's interesting. In 2008, so many people lost their shirts. One of the reasons is that they had a higher loan constant than the cap rate. And they're wondering, why am I losing my shirt? That's because they didn't know about this. And here's why they were doing it. They were saying, I want to get a 15-year loan at a lower interest rate than a 30-year loan. And what most people didn't realize is that the banks were giving them these 15-year loans, telling them it's a lower interest rate, but they're shifting all the risk to them. So you have to know these things, and that's one of the reasons that people lost their shirts. You're going to see many other reasons right now here in a minute. So going back to the spread, let's go back to, here's the first lesson. To generate a spread, you need an income-producing asset on one side, and on the other side, you need leverage. On the income-producing side, you're going to look for the cap rate. And on the leverage side, you're going to calculate the loan constant. Again, the formula is in the back of your book. It's nothing more than your annual payment divided by the loan amount. And you want the cap rate to be more than the loan constant. And that's straightforward key lesson. So let's go back to our skeleton. This is our deal skeleton we started with. And we have to understand how to control these things. So we said for the spread, you want the cap rate and the loan constant, and you want the cap rate to be more than the loan constant. So hopefully I'm not going too fast here. I'm trying to, let's see, how are we doing on time? Man, we have a lot to cover. Okay. So let's keep going here. So let's go back to our deal. Okay. So our deal we have in the first one, the 80% loan. Okay. What I want you guys to do now is pick the best loan. And I calculated the loan constants for you down here. So the question is, which one is the lowest loan constant? And the answer is obviously 6%. Okay, so C is the right answer for the loans. However, let's go back and look at the interest rate. Which one is the lowest interest rate? So the 4.2 is the lowest interest rate. It just happens to be, in this example, the highest loan constant. So this is the least flexible and the highest risk loan for us, and yet that's what people were signing up for in 2008. If you look at loan C, it has the highest interest rate and yet the lowest loan constant. It just happened to be like that in this example. That's what I want to try to demonstrate here, is that you have to look at loan constant, not just interest rates, folks. You have to look at loan constant, and they take priority over interest rates. Okay? So with that, we know the answer now is C for the first one. Let's continue here with the second dial. So if anyone has any questions, feel free to. Okay, so Natalie's asking a great question. She said, what if you have an interest-only period that's less than the hold period? Do you have average over hold period to get the loan constant? So Natalie, you're asking a great question. So let me just say this. Whenever you're putting those deals together, you have to be looking at a number of things. All I'm trying to do is introduce you to a loan constant to look at as well. One of the things you also have to look at is your exit strategy. If you're going to hold this for 10 years, you want to make sure your loan that goes beyond that. You don't want a loan that matures before that. So you really want to make sure that you match the exit strategy to the loan period. I'm just giving you one metric to look at, which is the loan constant right now. So someone is saying, someone is talking about the interest only. So again, it doesn't matter whether it's interest only or not. I'm just simply giving you the metrics to look at. Okay, so let's go back really quick. I want to just point something out. Now, in real life, let me just say this. This is the lowest loan constant, C, but and the answer is C for this exercise. But in real life, I would actually pick this, the letter D, because it's slightly higher loan constant, but not too much higher. But this is amortized over 30 years. Okay, so I personally would have picked D in real life because, again, it's slightly more. But the exercise is strictly teaching you how to look at loan constants and how to measure them. Okay, so hopefully that's helpful there. So let's continue with the second dial now. Let's look at leverage. You guys are asking great questions. So let's talk about structuring leverage. So let's go back to our deal here. We have spreads. We talked about spreads. Now we're going to talk about the leverage part, the next piece in the skeleton, and how do we control it? Okay. So what's the best way to structure a down payment? Let's start with that. So I'm going to give you three options here. What I want you to tell me is which of those is the safest and which one is the highest risk. So the first one here says you want to use your capital or your money for down payment. The next one says you want to use equity financing or partner. And the third one says borrow the down payment and use that for down payment. So what I want you guys to do is tell me which one is the lowest risk. And if you want to be bold enough, tell me which one is the highest risk. So I see people saying debt financing is the lowest risk, borrow higher. Okay. Awesome. I love interacting with you guys. I learned so much about so I just want to say this. This interactive part, this is how you best learn. And so So I'll just tell you that some of you have said some things that you'll only find out the result of it 2-3 years later. Part of the real estate is it's easy buying real estate. It's harder keeping it after a few years when the market starts going down or up or whatever. So when the market starts going down, that's when you realize how debt works against you. So I'm going to be sharing some of this stuff here in a minute. So let's go over back through our questions. Which one is the safest to use? This is the right order. The lowest risk is equity financing, meaning quote unquote partner. It doesn't mean they're actually partner in the deal in terms of making decision. They're simply participating in the upside. They're not necessarily making decisions with you. We'll talk about that. Second one is your capital and the highest risk for down payment. By the way, I want to just say this. This assumes you're buying at retail, not at a discount, but at retail. The worst thing you can do, folks, is use borrowed money or debt financing for a down payment. And I'm going to explain why here. So this is the order in terms of safety, from equity financing all the way through debt financing. So let's explain why. So what I'm going to do is I'm going to give you a mental model to remember the stuff, because I'm all about trying to remember things without memorizing. So you'll see here in front of you, you have some weights and you have feathers. So what I want you to do from now on is think of debt as weights, okay? And think of equity as feathers. So here's something to remember. Every single asset out there, every single asset, whether it's real estate, whether it's trusted investing, whether everything out there, every asset can only carry so much weight, and the weight is debt. And the first thing you need to understand is what is the maximum amount of weight that asset can carry. And if you don't know that number, you're playing with fire. So this is again on page 5, fill in the blanks. Okay, and that's the last part, mental model. Every asset can only carry so much weight. So let's look at that here. So the first thing you have to do when you're putting a deal together is you have to figure out and measure how much weight can this asset carry, okay? And then if it can carry, let's just say 80 pounds of weight, meaning debt, you can always use up to that, or less, but you don't want to go more than that. So the question is, how do you know what's the maximum? We're going to show you here in a minute. So here's what happens. Let's look at an example. Let's just say this asset here, whatever it is, it's a $100,000 asset. You calculate that it can only carry so much debt, which is $60,000. That's the weight. So then you have to fill the rest with equity. You don't have a choice, okay? So you always start by understanding how much debt there is. What I want you to remember this is, remember the word debt, dead weight, and just replace dead with debt. Debt weight, okay? Remember, you always start with how much weight something can carry, and then you fill the rest with feathers. So the question is, how do you know how much debt we can carry? So we're going to cover that right now. Let me just go through this here really quick. So the question is, how much debt can some handle? So I gave you the spreadsheet to calculate that. So let me walk you through. We don't have time to go through the spreadsheet right now, but you have it, and I'll just walk you through essentially how to do this. So all the yellow cells, you can fill in. So you see here, there's a number 1, asset annual data 1, 2. That's the order in which you fill things out, and the result is 4. So you fill in the asset information, the price, the income, and the operating expenses. And over here on number 2, you fill in the loan terms. You're not filling in the loan amount because you're trying to figure out what's the maximum loan, just the terms. Is it fully amortized or interest only? Number of payments per year is 12, almost always. 30-year or 15-year, and the interest rate. That's it. For number 3, just keep everything as is for now, okay? And in number 4, it gives you what's the maximum amount of debt it can carry. In this example, it can carry this asset, whatever it is, can only carry 77.97%. Literally, that's the maximum it can carry. So you can always go less or the maximum, but you cannot go more. If you decide to go more than that, It's okay, but you have to offset that risk with reserves. That's where reserves come in, okay? So again, you can download the spreadsheet from, you see here the link. You're welcome, Mike. So, okay, so I'm gonna go through this here. So this is how you calculate it. You figure out the maximum weight for debt, and then you fill the rest with feathers. So let me explain to you what would happen if you have too much debt, and what would happen in terms of a deal. So imagine two friends decide to buy a 100-unit apartment building next to each other. The first one gets an 80% loan, and the second one gets an 80% loan. So now you have two friends. They both get the same exact 80% loan on this 100-unit apartment building. The first guy says, I'm going to get 20% equity financing, and so I'm going to raise the whole down payment from someone, and we're going to share in the profits. The second one says, you know what, I'm going to borrow the money, and I'm going to pay them a specific interest rate, but I want to keep the whole building for myself. I'm going to use 20% debt financing. So the person on the left already has 100% debt. Notice they have a debt down here and debt up here. This is 100% debt. This person has 80% debt and 20% equity because they measured how much it can handle. So what does that result in? The person on the right, they can afford, loosely speaking, they can afford to have 18% of the people move out, meaning 18 people out of the 100 units move out before they get to break even. So they have a lot of flexibility in this example, okay? A lot of cushion. The person on the left can only afford to have 6% move out. Again, loosely speaking, 6 units vacant before they hit break even. Now, the actual number when I did this example was 5.5%. So what's the problem with that? That means with apartment buildings, you always have to assume at least a 5% vacancy. So that means the person on the left is the same identical properties, same rent, same everything, but this person had too much debt against it. They're going to be losing the shirt 1 or 2, 3 years later because of they cannot have too much vacancy, and they're going to have a lot of problems with negative cash flow. So you see this here, that's a big problem. And that's where most investors out there are doing. They're like, I just want the whole property for myself or the whole asset. I'm going to just go 100% debt financing. And that's the result of that. Because they didn't measure how much debt it can handle. Okay. So, I'm going to skip this here really quick because so the safer way to structure down payment is equity financing, folks. You have to know how much debt the asset can carry, and the down payment is typically equity financing because of that. So let's go back to our skeleton here. So every deal has a skeleton that you have to understand how to control the piece of the skeleton. The first one is the spread. We said you want the cap rate to be higher than the loan constant, and the loan constant as low as possible. Create the widest spread. And when it comes to leverage, you want to know what's the maximum amount of debt you can have against the asset, and you have to fill the rest with feathers, which is equity financing. Okay, I'm teaching you how to structure deals here like the very, very, very best. So now we have the 2 pieces out of the 3 pieces here with the skeleton. So let's go back to our deal here. So our deal is we have 1 to 6 in the bottom of page 3. And so the question is, which one of those is the best deal for the down payment? So go ahead and tell me what you think is the best deal. Exactly, 6. You're absolutely right, Alisa. So, so now we have the answers. For the loan, it's C, and for the down payment, it's 6. Okay, so now we know that's the right answer. And the question is, how do you feel by just looking at the deal? You can just look immediately and say, you know what, I get it, it's C6. And now when we're raising money from friends and family and structuring the deals, even with our own money, we know how to structure it as low risk as possible. I have seen people lose over 1,000 apartment units by the time they retired because they had way too much debt, and they retired and they had lost everything they had built for years and years, and only because they didn't know how to structure the capital structure. And you know now how to do that. And if this person had only known what I just shared with you, he would have had a very different lifestyle. Okay, isn't that sad? By not knowing one single thing, which is right there, we just covered it right now, it makes all the difference in the world. That's why most people are learning how to buy assets, which is great, but they're not learning capital structures, and that's so missing. And that's why we're doing this training. So hopefully you guys are enjoying this. So now we just covered, we started by looking at a deal, and we looked at the foundation, and we realized there's a skeleton that we have to understand for every deal, and it's made up of 3 pieces: spread, leverage, and reserves. We are controlling the spread, we're controlling the leverage, and now we're going to look at reserves. And by simply knowing these 3 dials, especially the first 2 we just covered, you're already ahead of most investors out there. So for reserves, let's talk about reserves really quickly here. So again, let's go back to our deal skeleton. We talked about spread, leverage. Let's talk about reserves. Now, reserves is a very, there's a lot to cover for reserve. I'm going to give you a few things here to think about. First, I want to start with this. Have you heard people telling you this? You have money in your checking account sitting there doing nothing. Okay, how many times have you heard that? This is the worst advice when someone tells you the money's sitting there doing nothing. I want to just tell you that if you looked at my bank account, you're going to say, George, you have a ton of money sitting there doing nothing. Let me explain why it has to be there, okay? Here's why. I want you to remember this. A building's foundation, so think of a building, a huge 100-story building. What holds the building is the foundation itself, right? The foundation holds the building. So building's foundation is to the building. What reserves is to leverage. So the reserves, if I'm going to borrow $10 million, I have to have enough reserves, because that's what really screws things up. Leverage is incredible. It's incredible, but you have the way you handle the foundation of that building is reserves for leverage. So anytime you start using a lot of leverage, you have to have reserves. They go hand in hand. And so when someone looks at an account and says there's $50,000 doing nothing there, what you have to say is that holds the $1 million or the $500,000, whatever it is in leverage. Okay, that's the foundation. So you can't just say I'm going to use that money to buy something else, because now you just put your whole other deal under risk. That's why this is so important. So the question is, how much should you have in reserves? Now I'm going to give you a simple formula for now, and this is what's called primary reserves. For more advanced training, we talk about secondary reserves and all that stuff, but for now, let's just keep it simple. Primary reserves, assuming you don't have any big fix-ups or roofs to fix or whatever, if everything is performing as a rental property, for example, here's what you do. You take your monthly loan payments on the loan, plus the monthly operating expenses on the asset, whatever your monthly expenses are, you add them up and you multiply by the number of months you want to keep in reserves, typically 3 to 6 months, okay? And so anytime you start adding more debt to the asset, more than it can handle, like the ones I showed you earlier, then you start increasing, you offset that risk with more reserves. So that's the deal here, the formula. Now, what I typically do with my deals is I say, you know what, I'm going to start with 3 months of reserves, but I'm going to have money coming in from the deal and go into reserves and expand it to 6 months, okay? So that's one thing I do. So let me walk you through how do you get the money for reserves. Here are the 3 types of money you want to use for reserves. The first one is equity financing. And what I mean by that is, if I'm going to raise, let's just say, $100,000 for a deal, I would tell the person, I'm going to raise 105 or 110, 100,000 goes into the down payment, and the remaining 5 or 10,000 or whatever it is goes into reserves. So I tell them that because it is in all our best interest to have reserves. The other part of them you can say is, I'm going to put up some of my money. That's your capital here if you choose to put your own capital. And finally, one of the things I do is I say, we're starting with 3 months of reserves. We're going to take cash flow from the rent or from the asset, and we're going to build our reserves up to 6 months, and then we'll start distributing the income. So that's how I do it for reserves. Here's the thing: don't ever use debt for reserves. I see people borrowing money from one place to put it in reserves, and they keep borrowing money from one place to pay. You never want to do that. You don't want to use debt for reserves. It's so critical you get that right, because it can destroy you. Okay? So again, money for reserves come from equity financing, your partner, cash flow from the asset, or your capital. So we just touched on spread. Again, is cap rate and loan constant. You want the widest possible. Leverage, I'm giving you guys the blueprint here. And I just want to say, this makes you so much better as an investor, by simply understanding these few things we just talked about today. And reserves. DS means debt service plus operating expenses times number of months. Okay, that's everything is based on numbers, folks. You know, I used to work at Intuit on Quicken and stuff like that, and I have to use numbers for everything because I knew the software was being used everywhere, nationwide, worldwide, and everything had to boil down to numbers. So it was my responsibility to make sure everything, adds up. And these are some of the numbers I'm telling you right now that you have to have for your deal. So we're done with structuring reserves. Let's conclude this call here. Let's just summarize a few things. So again, hopefully you guys are enjoying this. Let me know if you're enjoying it first before we conclude here. Perfect. Excellent. Excellent. Okay. Excellent. Thanks, guys. So let's continue here. So let's summarize what we talked about. We said with every single deal, it starts with 3 sides. You need a capital side. That's the money, whether it's a mortgage or equity financing or whatever. You need to buy the asset on the other side, and you need to structure the capital exactly like I showed you. Okay? When it comes to structuring the capital structure, you have to look at 3 different pieces to control the deal, the skeleton of the deal. The spread, you want a positive spread. I'll just give you the calculations for that. You want the exact amount of debt, not too much, okay? And reserves, we talked about that. That's again on page 13. Everything is in your notebooks, folks. Download the notebooks. Ultimately, here's what you want to do. You want to have a portfolio of wealth pairs. You want to have, again, because this is not specific to real estate, you want to have wealth pairs generating passive income in your portfolio. You want to have things like income properties, private lending, insurance arbitrage, businesses. We have our students doing wealth pairs from all different kinds of assets, okay? And it all works the same exact way I just showed you. So your goal is to have wealth pairs, various assets generating passive income, and structured to be as low risk as possible and as hassle-free as possible. If you don't believe me, talk to anyone that's lost properties, and they'll tell you they haven't been able to get back into real estate because it has impacted their confidence so much. It shatters your whole confidence. So don't structure things just for high return because it's so easy. When the market starts going down, debt works against you. Debt becomes your worst enemy. Debt is great when things are going up, but you have to know how to control debt, because when the market starts going down, and we know it's a matter of time before it starts going down, you have to manage your risk, and you manage it by knowing how to control your risk, your debt, and your reserves. So let's look at how much have you learned in this session. Now, there's a few things I skipped because of lack of time, but let's just look at what happened with most investors in 2007, 2008, and see if those are mistakes that we would do right now. So here are the typical capital structures in 2007, 2008 with a lot of investors, okay? Number one, so many people got 15-year loans because they said they want to be debt-free in 15 years, so therefore their loan constant was significantly higher than the cap rate. First mistake, it's the wrong spread. It's what's called a negative spread. Next one is they used HELOCs, lines of credit from one property. They took it and they used it as a down payment on another long buy and hold. So now that means they have 100% debt financing. Okay. The third one is there's a lot of people that did seller carrybacks, where the seller is getting paid 10% interest on the seller carryback, but the property that just they sold to us was 8% cap rate. That means the loan constant is higher than the cap rate again. Big mistake. Negative spread. Next one is, I skipped this part, but you always want to have your loans to be fixed interest rate for long term. You never want to have them adjustable because it creates a lot of uncertainty. I am so big about risk and mitigating risk. Some were using 0% credit cards for down payment for long-term buy and holds. The loan constant on a credit card is between 18% and 36%, even though it's 0% interest. Okay, and so you already have 100% debt financing and you have negative leverage. I mean, every mistake that can be done is being done. Finally, people would always be saying, my money is sitting in the checking account doing nothing, and they had no reserves. Okay, again, we would never do these things right now, but just strictly literally 1 hour training, most investors would have saved their portfolio by just knowing this information. And I'm just giving it all to you guys right now because I want you guys to learn this stuff. Okay, so what is the cost of not knowing this? I will tell you, talk to anyone in 2007, 2008, and they'll tell you the cost of not structuring these things right. It is a matter of having an incredible lifestyle and being having your confidence shattered because of losing properties. Okay, that's the cost of this. Now, a lot of people would come to me and say, you know, George, what you're teaching us is good debt versus bad debt. That is actually not true. I just want to say this. Robert Kiyosaki, in his book, excellent book, Rich Dad Poor Dad, incredible book, talks about bad debt versus good debt. And he says good debt puts money in our pocket. Here's the thing that we're talking about. We're taking good debt and we're saying within good debt, you have to know how to use the right type of debt. Because good debt, everything we talked about, 15-year loans, loan constants, these are all part of good debt. But if you don't know how to calculate those things, you can use good debt to destroy you. So we're talking about a subset of good debt, what we call strategic debt, and that type of debt, measuring it, calculating it, managing it is so critical that you know that. And that's what we're talking about. It's a subset of that. So I want to end this with sharing with you a few stories I've heard. There's so many stories out there, but here's one of them. An investor raised $250,000 from friends and family, invested into rental properties, and lost both properties and family money. Things will never be the same in that family, okay? And all because they didn't know how to structure the deal. That's it. They did all the right things, the right assets, the right capital. Everything was perfect, except the capital structure was incorrect. And that's what happens with this. I can go on and on with so many horror stories, all because they lacked this understanding, this training. So here's an important decision you have to think about. From now on, whenever you structure deals, are you going to just hope and pray, I'm going to just raise money and just buy this thing? Or do you want to use a very methodical approach? Everything you need, folks, is in your workbook to do these methodical approaches. And make sure you watch this training again and again, because it can help you so much. So make sure, and again, I have checklists in there on page 9. I have a complete checklist on everything you need to do when you're structuring those deals. Okay, so make sure you follow the checklist. The checklist has numbers on top, 1, 2, 3, 4. That's the order you want to follow the checklist. So it's all in there. And this truly is putting you in a position to structure deals like the very, very best investors on the planet. So with that, thank you for allowing me to share this. What I'm going to do now, Nate, is we can take a few questions. And I know there's a few things you wanted to share, and then I'm pretty much done from my side. What would you like to do from here, Nate?
I just typed into the chat box. I'm going to keep it really brief because I think you shared a lot of good information. So I want to not really take any away from that, but I do want to add a couple things, George. I was writing notes, and it seemed like our presentations almost mirror each other in certain ways. When you're asking the questions, I was answering to myself in my head and realizing that we kind of speak the same language. I think it's very important, especially for beginning investors. I think you probably agree that debt could be it could end your career very quickly. I've seen people take on a lot of debt in their beginning stages of their real estate investing career, and then the debt just kills them. They don't know how to manage it. And one of the things that I talk about when we talk about our private lending and borrowing class, where we talk about different ways that you can structure money partnerships and things like that with other people's retirement accounts, is that sometimes it's safer to set up an equity partnership because depending on how you structure it, you're not at risk of defaulting on a loan. You might have to give up a little bit more of the profit in order to set something up like that. Because I think if you take it from the other perspective, for instance, me, a lender, for me, I would prefer not to be in an equity position because I want the safety net of being able to, take a property back if somebody didn't pay me. But with that said, would I do an equity partnership if the terms were right and take a little bit more risk as me, this is the money partner? Sure, I would do that all day long. So I think it's important for investors to kind of understand that there's a lot of different ways that you can structure your deals and involve other people, whether it's involving lenders or money partners. But like you said, I think most of the stuff that you presented will get people to a finish line that most people don't ever reach because they don't break it down very simply like you did and actually analyze the numbers.
Yeah. One thing, Nate, someone just asked, should we go 100% equity financing? And I want to say something about that. That won't end up working out very well for the person putting up the money. So let me expand on that really quickly for the person asking. So I'm going to role play with Nate here just to explain. Let's just say that I'm raising money from Nate. Let's just say I'm buying the $100,000 asset. Let's go back to that. And Nate's going to put up the whole $100,000. And I'm going to tell Nate we're going to go 50-50 on the deal. Okay. So I don't have any debt. Now, if whatever the cap rate is, so I want you guys to think about this carefully. If the cap rate is, let's say 6%, and he's putting up all the money, and I'm giving him 50% of the deal, that means he's going to get 3% return on his money because it ends up being approximately half the cap rate if there's no debt whatsoever. So that means he now is getting screwed with that low return, and I'm getting a huge benefit. So what ends up happening is for you to be able to get Nate a good return in this example, I have to use just enough debt, not too much because I don't want to put his money at risk, just enough where the loan constant is lower than the cap rate. What that does is it creates a bigger percentage for us to share. And then when I share with him his 50% on a bigger number, it becomes very interesting for him. So now I might be getting let's just say a 12 or 13% return, and now we're splitting. And something that Nate said here that I want you guys to be careful about, that he there's a lot of wisdom in what he said, is just because it's equity financing, it doesn't mean you're going to actually make more money. Being a private lender in this example might actually be better. If he's going to lend me the money at 8%, it might be actually better for him, right? And so you have to learn how to look at both sides. Just because I'm offering him 50% sounds like a big number, but it might end up being a small number. So what he's saying has a lot of wisdom in it. And so you have to look at both sides. But at the same time, if I was to borrow too much debt from Nate, I might be shifting the risk to me. So what it boils down to, and what we're saying here, Nate and I, is that there's a certain amount of risk, and you don't want to shift too much here or too much here. You have to manage the whole thing by managing the amount of debt and managing the returns and all that stuff.
It's
So
just like in life. You got to find that proper balance.
that's
And
exactly
that's the
correct.
difficult part. And I think that's what kills investors is they don't really take the time to kind of look at how you presented it. And I think this is phenomenal information for anybody who's an investor is you got to find that right balance between debt, equity partners, keeping cash and reserves. I love how you stated that. I mean, I'm from the banking world and, we wouldn't give loans to people who didn't have money in reserves to make up any payments and things like that. So it is
Yep.
a key to have cash and reserves. And here's the other thing that I'll add too is, especially when we talk about using private money, retirement money, obviously that's, kind of what we do here at Quest is, it's good to incorporate or engage other people into your investment business. I always like to call it a business. If you're a real estate investor, you're running a business. But the best real estate investors I know are the people that have lists of private lenders and they have equity partners. I think if you're just focused on one style of how you're raising your capital, you're just not going to go very far. Plus, the more people that you get involved in your investments, the more lenders and equity partners you make money for, well, then you're just going to have people beating down your door to be involved in those investments as well. So.
Yeah, I love what you're saying, Nate. There, one thing I want everyone to think about is so there's actually 3 levels, but we're just going to focus on 2. One level is at the asset level, and everything we just talked about here is at the asset level. And so you have to control the debt at the asset level. But the other thing also that Nate is referencing is your whole portfolio. You have to be looking at the debt for your whole portfolio as well. So it's not just per deal, but per portfolio. So the whole portfolio. Is there too much too much debt in your portfolio? So these are different things you have to learn to do. And today what we covered is really just at the asset level, but you really have to take the time because we talk about debt and equity across different levels. And Nate, I'm blown away by your background. I mean, you're saying a lot of excellent things. This is the first time we're meeting, and I've heard so much great things about you. But I can see we're coming from the same background.
Well, and I'm thinking the same thing. This is the first time me and George have actually even met, but it seems like we're talking kind of the same language. And we probably come from different backgrounds, but it kind of feels like we're meeting at the same crossroads and talking about the same thing. So, I really appreciate you spending time with us, and I want to do more stuff with you. I don't know. Obviously, I'm not putting you on the spot, but what I was going to say to anybody who's interested in hearing more about George's education is I was going to invite you to speak on our Financial Independence webinar, which is coming up, I believe, the last weekend of June, just before Independence Day. I'll send you the information. I don't want to give people a teaser, and I don't want to put you on the spot. I don't know if you've got plans that weekend, but I was just going to say I'm pretty sure that the attendees are going to want some more George Antone time.
Yeah, this is I'm so passionate about this, and this is what I live and breathe every day. And I think the big thing that also, Nate, that we're both saying for everyone is you have to learn to measure risk. You don't want to just look at return and measure return. You have to measure risk. And I'm not talking about just talking this is risky. You have to actually put a number to it. And so you do that by controlling debt, by controlling spreads, and all of these are numbers. So there's no emotion in it. It's just that it's either it's what's the scale of risk, and that's something you have to learn. So if I end up coming, if I have time, on that weekend, I would love to. We can talk more about that and how do you measure risk and using some of this information here. So that's awesome.
Yeah. Well, I'm gonna end with a special offer, if that's okay with
Go ahead.
with you, George. So let me just switch my slides here and make sure you guys can see that. Can you see my screen now?
Yep.
Okay, I'm just going to skip past this. And I know we probably have a lot of clients on the phone that are already account holders with us, but if we've got any other new people, what I wanted to say is George just gave us all a great foundation to work with to have really a long-lasting career as an investor. Now, obviously, being an investor can mean a lot of different things for people. Some people are full-time investors. That's what they do to put food on the table, for them and their family. Some people are just passive investors. But I think regardless of which one you are there, I think one of the important things too is to take some of the information that George provides you and actually apply that to things like the product that we have, which is your self-directed IRAs. And the reason you want to do that is not only to leverage his education on how to make safe investments, but now use our education and how do you do those investments in a completely tax-free manner. The other thing with these self-directed IRAs that we provide is it also allows you the information and the education on how self-directed IRAs work, because one of the largest places or buckets of money to search for your private money and your capital from other investors is through other people's retirement accounts. There's $29 trillion sitting out there in private capital that's available to us as investors if you're looking to raise private money for some of your investments. And these same strategies that George is presenting apply to those retirement accounts, whether or not you bring on debt investors who have retirement accounts, whether or not you bring on equity partners through retirement accounts. And one of the things that we like to preach at Quest is not only do you have to analyze the risk for yourself and make sure that you're not putting yourself into risky situations, but when you're dealing with people's retirement accounts and you're using that as a source of income, you also need to take their consideration, their risk tolerance into play, because every investor who has a retirement account who may invest with you, you also have to, they're leaning on you to be the expert. So this education that George provided is gonna handle both things. How do you develop these strategies and make them tax-free in your own retirement accounts, but also how do you use other people's retirement accounts to fund some of your own personal investments? I'm gonna do a little offer here, and I just wanna let people know, if they're not familiar with Quest, we're a self-directed IRA provider that provides 7 types of accounts that you can use to invest in things like real estate, promissory notes, investments into private companies. If you go to our website, questtrust.com, we've got a lot of real good education that shows you how these self-directed IRAs work. I'm just kind of showing you the 7 types of accounts that we have here at Quest. One of the cool things about Quest is we don't sell investments to our clients. We simply give you the vehicles for you to pick your own investments, but do it within these types of accounts that end up growing completely tax deferred, or even better, completely tax free. And me and George were talking at the beginning of before the show, and to my surprise, he went along with my idea, which is decided if anybody wants to open an account, not only am I going to waive the account opening fee for any new account holders or current account holders if you want to open an additional account that you don't have. But if you do that and you use a special promo code that we've made just for George, if you open an account between now and the end of the weekend, not only are we going to waive the account opening fee, but I believe George, if he's still willing to, is going to send you a copy of his book, which is, that is a value in itself. So if you want to open up your own Roth IRA and start applying his strategies in a tax-free Roth, or if you're self-employed, you can set up employer plans. If you've got kids under the age of 18 and you want to start paying for education expenses tax-free, we've got the ESAs, and we've even got the HSA that can hold real estate investments, and you can pay your family's health expenses with tax-free dollars. I'm kind of oversimplifying this stuff right now. We have IRA specialists on staff to kind of answer all the questions that you have about how these actually work. But if you want to just break it down very simply, we've got tax-free accounts that allow you to do the things that George does in his real estate strategies. So if you marry those two together, I think that's a great blueprint on how to retire, and retire quickly with passive income, tax-free income, and safe income as well. So we've never had that kind of offer here where somebody was actually willing to, share their education. So if you guys want to open an account, I think all you got to do is just email IRA specialists at questtrust.com. An IRA specialist will reach out to you, and we'll get that information over to George, and he'll ship you out one of his books. And I really hope that he can make it on that Financial Independence Day webinar. There's some information on that. June 29th. It's from 10 to 4 p.m. If George can't make that, I rest assured we'll get him on something, whether it's live or it's online. We'll wrangle him in at some point. I'll make sure Ingrid tracks you down and get you involved. But again, like I said, George, appreciate meeting you. Appreciate your time. We got a ton of attendees on here, and we're going to record this too. It's going to be recorded, and we'll send it out to everybody that registered, just so they make sure that they caught everything, because I know some people might have had to cut out a little bit early.
Awesome. So again, I'll be sending out the free book, my free book, The Wealthy Code. We'll just need an address, and we'll just ship it out. And I'd love to help in any way. Again, I think we all have one thing in common here, which is we all want this, what we call let's go for financial independence and financial freedom, to be able to live the lifestyle that we've always wanted. And I think with this information that you guys and the service that you guys provide is incredible. I know a lot of people are going to be, taxes is one of those big things that really holds you back and slows you back so much. And by working closely with tax-free advantages, having tax-free or tax advantage environment is so critical to your success. And so I think you guys do an incredible job with that. So thanks again for having me. And I think this is awesome what you guys do.
Well, this is awesome. So again, thanks, George. I think the attendees are pretty happy, judging by the comments there. If you guys have any questions, you can email me if you want. There's my email address. George, did you want to give your email address, or do you want us to just send you questions? I don't know how you want to do that.
Yeah, no, you can send me questions. I have way too many emails coming in, but if you guys,
I figured that.
Yeah, that would be great, and then we'll make sure we answer them.
Okay, sounds good. Well, again, thank you everybody for joining. Have a good rest of the weekend, and George, yourself, can't wait to get you on another webinar or live event.
Excellent. Take care, everyone. Thanks, Nate.
Yeah, no problem. Have a good one, everybody.